Alright, hey traders, today is July 18th, 2012, and this is Julian Marchese bringing you guys a market update for today and just an outlook on my current positions and what I'm looking to do in the markets today. So, as you've probably noticed, the equity market has rallied pretty significantly over the last 4 days. We've seen a lot of choppy movements since basically mid-April, mid-May. After that significant decline, we've been just chopping around at these levels. I'm currently on an medium-term to longer-term basis bearish on the equity markets and most risk markets. I think that investors are going to continue putting capital into the US dollar. Really, I think the market theme right now, as I've mentioned multiple times before, is no one wants to be in European or Asian equities, and so that money is moving from risk assets and even treasuries in some places, well, bonds in some places, in Europe and Asia into the United States, and that's why we've seen so much outperformance in equities, U.S. equities, U.S. corporate bonds, which is indicated by HYG high yield debt, and also obviously into treasury bonds, which has been the flight to quality scenario. You can see that the 10-year yield is at 1.48, which is extremely low. I think that the bond market basically is telling the true picture of the economy right now, and you can see the yield on it is consistently going lower, indicating fear in the financial marketplace, global financial marketplace. So I think that is going to continue. We're going to continue to see a flight into bonds. I remain to be long, and I have been long bonds for quite a while. In regards to the euro, I think the euro still has a lot of potential to go lower. However, there's definitely massive shorts in this thing that can be squeezed at any point. So I would not be surprised if we see some sort of extreme push higher in the euro from a 1 to 2 day, basis. So just a 1 or 2 day just explosion to shake out the weak shorts before we go lower. And I think that scenario would be an awesome opportunity to get long dollars and short risk, as I think the euro is the greatest proxy right now for risk. You can see the euro, as long as basically Europe continues to be the center of attention, or at least the US doesn't come up with any significant major problems, the euro will continue to be the best market as a risk-on perspective. It's just shown, except for basically in 2011, the August meltdown, it's shown the risk-on theme quite accurately. And obviously the reason we didn't see any movement in August of last year is due to the fact that that was a US-centered correction in equities. So in the case of oil, I'm really liking the levels it's coming up to. As I'm bearish the economy in general, oil is also a great proxy to use as a risk-on market, as oil tends to move in the direction of global demand, obviously. So if global demand goes down, the price of oil falls, and that's why we saw such an underperformance of oil in May, as China continues to slow down, which is a huge consumer of oil, obviously. And China is also a huge consumer of metals, industrial metals, such as copper. And so copper is also a great way to express a short position on risk-on assets. And I continue to do so through these markets. As you can see, these markets are underperforming. The general market right now, at least copper is. Oil has been getting a bounce due to its significant underperformance. Steel is also, which is expressed by United States Steel Corporation. Steel has been really lagging and has been a good short idea. And then, if you're looking for another stock to use as a copper proxy, you can look at FCX. So, FCX and United Steel, for example, these are just heavily beaten up stocks and look like they want to go lower just based on their chart. FCX has a support level here that could be broken any day now. But as has been the theme for multiple months, well, really since 2010, US equities continue to outperform. So my best idea, or I think the best position to have right now, is a long equity, short something like oil. If you want to be hedged in some sort of way, that may be a good way to do it. I personally do not like to really spread trade that much, as it limits your options in regards to how you can maneuver around legs. Well, actually, I take that back. It can definitely offer new ways to trade markets, but I usually use spreads just to express an idea. So basically, the idea is oil should continue to sell off more in regards to uh, in basically equity terms. And as you could see, oil has outperformed lately, so that may be a good trade. You know, it's come in a nice percentage amount, so we could see that balance. And by this balancing, we would obviously see oil underperform. And when oil underperforms, usually that's when the stock market is also underperforming, but just not as much. So bottom line, I remain risk off. In other words, I'm long treasuries. I'm short. Well, right now I'm only short commodities such as oil, copper, and I am short a little bit of gold, not that much. However, I am looking to short equities if we can get above that 1375 level. Um, in the S&P, or if we see a reversal. If we see a reversal, say in the next few days, and we fail to hit that 1375 level and make a lower high like this, that would be a great signal that we are going lower in equity markets, and it would definitely tie into, you know, major levels on like a weekly chart. You know, we're basically touching 2011 highs right now, and it would make a nice lower high on the weekly time frame as well. So that's what I'm looking at, guys. I will continue to have this market bias and direction and positions on this direction, unless any significant changes in, you know, whether it be Europe, Asia, or the US come to fruition. Obviously, if we see some sort of a Fed accommodative policy, if we see a QE3 come out, I would be reluctant to sell stock at first unless the market itself realizes that QE3 may not be the power that the economy needs right now. I actually recently wrote an article on Seeking Alpha regarding it, how QE3, you know, quantitative easing by its definition has basically, the more you do it, the less and less useful it becomes. Now with yields at 1.4%, a drop in yields from 1.4 to say 1.2 or 1%, I don't think is really going to change the mindset of the average investor, and I don't think that's going to cause investors to go into riskier assets. I just don't see that, due to the fact that, you know, treasuries are already yielding negative rates, so a little more, you know, negative rates, I don't think isn't really going to change much. So even with negative rates, investors continue to pile into bonds and out of equity. So I don't think QE3, if it does come around, will have a huge implication. But obviously, at the beginning of the announcement, wouldn't want to be trying to fade a large rally in stocks. So that's my outlook for July 18th. Hope you guys enjoyed it.